You know, every single investor out there has wins and they have losses. That's just how the game is played. But here's the thing. The real secret to success in the long run, it's not just about picking more winners. It's about learning the right lessons from both your biggest wins and your most painful mistakes. Believe me, I've been there. I've had some absolutely fantastic wins. I'm talking about companies like Nvidia, Palantir, and SoFi that just knocked it out of the park. But on the flip side, I've had some really tough lessons. Stocks like PayPal and Intel. Oof, those ones stung. And going through both those highs and lows made me stop and ask a really, really important question. I just had to figure it out. What really separates a great investment from a dud? What's the common DNA in all my winners, and what are the red flags my losers all had in common? So after a lot of digging and really thinking about my own experience, I've managed to boil it all down to 7 key rules. So let's dive right in. Here's what we're going to cover. We'll start with the big warning signs to look out for. Then we'll get into the good stuff, the hallmarks of a real winner. After that, we'll talk about having the right investor mindset. And finally, we'll wrap it all up into a playbook you can actually use. Just so we're clear, this whole framework is really designed for long-term investors. We're not day trading here, and we're specifically looking at the fast-moving world of tech. The goal? To find those amazing companies that are truly built to last. Okay, first things first, let's talk about what to avoid. Sometimes the best offense really is a good defense. And honestly, knowing which companies to just stay away from, that's half the battle right there.
All right, rule number 1, and this is a lesson I learned the hard way. Avoid the turnaround trap. I'm looking at you, PayPal and Intel. It's so tempting, right? A struggling giant gets a new CEO, there's all this buzz and excitement, and you think, this is it. They're going to turn it around overnight. But the reality? Changing the culture of a huge bureaucratic company is like trying to turn a cruise ship with a canoe paddle. It's a slow, painful grind. And investors, they're not patient. They want miracles, and when those miracles don't show up right away, they bail, and the stock just goes nowhere.
Rule number 2 is a big one. Stay far, far away from scandal. It's just like the slide says. Wall Street's hands don't hit the buy button when there's a whiff of scandal. Look, even if the rumors turn out to be completely false, it doesn't matter. That uncertainty is poison. The big money, the huge institutional investors that actually move the needle, they get way too nervous to jump in. The risk to their reputation is just way too high. Okay, enough of the doom and gloom, right? Let's flip the script and get to the fun part. Let's talk about what the hallmarks of a true long-term winner actually are. This brings us right to rule number 3. I almost always prefer companies where the founder is still the CEO. Just look at the difference here. A founder CEO, they act like an owner because, well, they are. They're thinking about their legacy, about the next decade, not just the next quarter. A professional manager, on the other hand, can sometimes act more like an employee. They're on that quarterly earnings treadmill, focused on hitting the next number. That long-term vision and drive for crazy innovation, it often comes from the founder, whose name is on the door. Okay, rule number 4 is non-negotiable. It's absolutely critical. The company must have a strong, durable, competitive moat. A moat is basically its defense system, that special advantage that keeps competitors at bay. It's the secret sauce that lets a great company protect its profits for years and years. But here's the catch. Not all moats are created equal. And this really breaks it down perfectly. A weak moat, it's like a sandcastle. It looks nice, but a competitor with a big marketing budget can just come along and wash it away. A strong moat, though, that's a fortress. It's built on solid rock. Things that are incredibly hard to copy, like game-changing technology, deep-seated brand trust, or a powerful supply chain. Think about Microsoft. Now that is a fortress. That's a real moat. Rule number 5 is so simple, but it's incredibly powerful. Invest where the growth is. You want to fish where the fish are, right? You want to find companies playing in markets that are just exploding. It's that classic saying, a rising tide lifts all boats. Think about it. A fantastic company in a totally flat market has to scratch and claw for every tiny bit of growth. But an okay company in a booming market like AI right now, it can do great because the whole pie is getting bigger for everyone. So all of this kind of builds to our next point because, you see, successful investing isn't just about analyzing a company's balance sheet. It's also about what's going on up here in your own head. It's about having the right mindset and, crucially, knowing who to listen to and who to tune out. So picture this. You're looking at a stock you're interested in. You turn on the TV, and some analyst is screaming buy.
You go online and another expert is telling you to sell. It's just a constant storm of opinions coming at you from every direction. So, who are you supposed to trust? The answer? Well, that brings us to Rule 6. You have to trust your own research. Period. Wall Street analysts, they're often playing a totally different game than you are. They're obsessed with the next 3 months, not the next 10 years. And sometimes their interests just don't line up with yours. I mean, we saw it with SoFi, where some analysts were publicly giving it a poor rating while their own banks were quietly buying of shares. You have to do your own homework. You have to build your own conviction. And finally, we've got rule number 7. Now, this one's more of a strategic preference, but it's a big one for me. I almost always favor brains over brawn. What do I mean by that? Well, brains companies are the asset-like designers, like NVIDIA or AMD. Their real value is in their ideas, their intellectual property. That makes them super agile. They can pivot on a dime. Then you have the brawn companies, the manufacturers like TSMC. Now, don't get me wrong, they're amazing businesses, but they're incredibly capital-intensive. They have to spend billions and billions on factories. That makes them slower to change and way more sensitive to the ups and downs of the economy. All right, so we've talked about the traps to avoid, the key traits of a winning company, and having the right mindset. Now, let's put it all together. Let's build your final playbook. And here it is, the complete 7-point investment checklist. Think of this as your framework for finding those really high-quality companies you can hold for the long haul. Again, this isn't for day traders trying to chase a hot stock. This is for investors, for people who want to build real, lasting wealth by owning a piece of a truly exceptional business. And that brings us to the final, and I think maybe the most important question of all. I want you to go take a really hard look at your own portfolio. Seriously, take each stock you own and run it through this 7-point checklist. How many of them actually pass the test? I bet the answer to that question will give you some real clarity on what your next move should be.